Yes. So now we have to look through what are the components of balance of payment. Components of balance of payment, you have two main components, that is the capital account as well as the current account. So current account deals with the import and export of all invisibles and visibles. Okay, and also the transfer payments. Then capital account means very big transactions are recorded in the capital account, that is like acquiring an asset in the other country, that is FDI, FPI, all such things comes under capital account transactions. So we have to look through what are the components of each account, that is current account and the capital account, in detail. So current account means it records all the international economic transactions related to export and import of goods and services, and also the unilateral transfers of international economies. So that is the current account. And capital account means it records all the international economic transactions relating to change in assets. It can be both physical or financial. That means, as I told you, if you want to buy a share of other country, that will come under the transaction of capital account. But if you are just sending a gift or a donation to a person staying in other country, that comes under current account transaction, that is a unilateral transfer. So as we have looked through in the before chapter, like this is a previous chapter, this thing, unilateral transfer means it is the one-sided payment, that is in return government should not, or whoever is paying it, in return they should not expect anything in return. Okay, that is unilateral transfers. So you have current account. Now we have to look through what are the current account transactions. First one is current account transactions. In that, first one comes under as the export and import of goods or merchandise, you can say. So exports and imports of goods comes under the current account transactions, that is visibles, you can say, visibles. Exports and imports of merchandise, that is also called as visibles. Just keep it in mind, visibles. And next is invisible items, that is services. Suppose a tax payment, like you are paying a tax, an income tax, like you are working in a abroad country and you have to pay tax. So what you will do is you can pay a tax, like the government will take an amount of getting that service done, and you can pay the tax. That is coming under, that is a service. So that is coming under the invisible item or invisibles. So services, export and import of services are called invisibles. Export and import of goods or merchandise are called visibles. So exports and imports of visibles and invisibles, together you call it as current account transactions. Then comes under, next is unilateral transfers. Unilateral transfers also comes under invisibles. That means gifts, donations, all such one-sided payment which you give to another country or the other country gives to you is also unilateral transfers, or you can call it as invisibles. Okay, so visibles and invisibles. And when you take visibles alone, that is the export and import of goods alone or merchandise alone, you call it as balance of trade. So balance of trade means it is just a part of balance of payment which includes only the export and import of goods, only goods. You have to mark it, you have to underline it, only goods, not services. Or you can say only visibles, not invisibles. Okay, so balance of trade, just you are taking what is the difference of import and export of a good. That is balance of trade. So balance of trade is a component or a part of balance of payment. So if you connect it with the forest, balance of payment is the forest and that tree is the balance of trade. Okay, so you have to underline it and make a note on that. That is balance of export and import of visibles only is called balance of trade. And when it is coming to balance of export and import of visibles and invisibles taken together, you will get the current account of balance of payment. Not the full balance of payment, only the current account of balance of payment. So next we are moving on to the, then in that itself, invisibles itself, you have certain incomes also. That is profits, dividends. Like when you buy shares from other countries, you get profit or you get dividend. So that is also added in the unilateral transfer of our country. So that all these things comes under the current account transactions under invisibles. So invisibles are divided into three, that is services, then unilateral transfers and incomes. So all these things taken together will give you invisibles of current account. Visibles means merchandise, that is exports and imports of merchandise. So all these things taken together will give you the whole current account of the BOP. I hope it is clear. You have to make notes accordingly. And capital account transactions or capital account, as I told you, when there is a change in asset, either physical asset or financial asset, we record it in a capital account or capital account. We record it in capital account. So that means when you purchase or like sell or buy shares from other countries, then you direct like FDI, FPI, all such things comes under capital account transactions. FDI, that is foreign direct investment. Two types of foreign direct investment can happen. That is when you open up a branch in other country whereby that main like what you can say the main business is going on the home country, and when you open up a branch in the other country, that is one type of FDI. Then other type of FDI is when you open up a new very new business in other country, that is also FDI. Okay, so the first type is also called MNC. We call it as MNC, that is multinational companies, whereby they own or they operate in one home country and they have branches in multiple countries. That is MNC. So FDI is of two types, either opening up a branch of a home country business, or you are straight away starting a new business in the foreign country. That is FDI. FPI means as we trade or as we have shares for our companies in the home country, we have shares for companies in the foreign countries also. So when you buy or sell shares from the foreign countries, it is called FPI. So that is foreign portfolio investment. Okay, so foreign portfolio investment and foreign direct investment directly comes under capital account transactions of BOP. So there is a change in asset is happening there. In FDI, change in financial asset is happening, and in FPI and all, like if you buy, if you are starting a business, new business there, it is an asset for you. So that is also changing both physical asset as well as financial asset. Okay, so that is why it is coming under the capital account transaction of BOP. So all these things taken together will give you the BOP. So current account transactions as well as capital account transactions. If you take down the page number 423 of Agarwal textbook, you can see that there is a structure of BOP given there. I'll be putting the photo there, you can go through that. So there is a structure of balance of payment given. So there it is very clearly given that the first part is current account. In current account itself you have debit and credit. As I told you earlier itself, credit means whatever is coming in. So how, like when capital is inflowing into the country? When you export things, right? When you export, you are exporting our goods or the goods which are made in our country to other country. So what will happen? In return, they are paying you money. So capital is inflowing to the country. So that is coming under the credit side. So exports under credit side and imports under debit side. So debit side means importing. That means we are importing goods and services from other countries. In return, we have to pay them. So capital is outflowing the economy. So that is debit side and credit side of current account. Then capital account also has the debit and credit side. That is investment to abroad, lendings to abroad, and foreign exchange reserves to abroad comes under debit side. That is everything is going outside the country. And investments from abroad, borrowings from abroad, as well as the foreign exchange reserves coming into the country is also recorded in the credit side of the capital account. So as we have discussed in the introductory part itself, it has to be equalized for being a balanced BOP. Credit side should be equal to the debit side. If debit side is exceeding, you call it as deficit BOP. If credit side is exceeding, you call it as surplus BOP. And as I told you, you can take BOT, that is balance of trade, alone from BOP. That is a part of BOP. So if exports are more, you will get surplus BOT. And if imports are more, you will get deficit BOT. If exports and imports of goods are equal, means you will get a balanced BOT or balance of trade. So these are the components of balance of payment. So you have to make notes like that, and you have to copy the structure into the notebook also. Okay.